Good morning, everybody, and welcome. It's another monthly economic briefing from the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Associate Rob Knapp, and it's great to have you with us this morning. So the magic number this morning is 311,311,000 jobs added to the economy last month. That is much less than the number from the month before, which has been revised downward, but still above 500,000. Also, this is a little bigger number than was expected, so we're going to talk about that. First of all, let's talk a little bit about how the briefing goes for those of you who are new with us. We're going to have on our executive director, Greg Brown, in a few moments, who's going to talk to us about the new number, what the Fed might be thinking right now, some of the other economic indicators, and other things that are good to be thinking about at this point. That'll be the first half of the briefing. The second half of the briefing will belong to you all. You are going to send us your questions, and Greg will be answering those. You can send those questions anytime you want. So if you've got one now and it's burning a hole in your pocket, please send it to us using the function at the bottom of your screen. Go to the Q&A function at the bottom of the screen, and you can put those questions in at any time during the briefing, now or later. For those of you in the press, we do prioritize media questions, so your name will be on the question, but please go ahead and add your title and organization as well. Now, if you're with us by phone this morning, you can still take part. You can email me your questions. Email them to rob_knapp@kenan-flagler.unc.edu. I know that's a lot. We're going to do this for about 30 minutes. We'll try to answer as many of your questions as we can. If you get them in late, it might be a little tough, but we will certainly try. I think that's everything that you need to know. So it is my pleasure to welcome to the program a guy that I have not had the chance to do a briefing with yet, our executive director, Greg Brown, who's been working feverishly over the last 30 minutes over these new statistics that we have. So good morning, Greg. Hope you're ready to go, and let's see where this thing goes.
Thanks, Rob. So yeah, pretty exciting report. A lot to unpack here, actually. So when I first saw the headline number, I mean, immediate reaction is like, yeah, that's another really strong number. And I think there was increased uncertainty as to what might happen in February, just given how strong the January number was, and people wondering, oh, was that payroll number in January because of weird seasonal effects or weather? The actual seasonal factors that are used in January are the most extreme of the year, and maybe it wasn't really that strong. It was kind of fake. But I mean, we see this number from February now for payrolls, and it's another really strong number by historical standards. 300,000 jobs is just really, really strong, and it's even higher than expectations, and it comes on the tail of this really strong January. So I mean, when you look at that headline number, there's just no way to not say, yeah, the labor market continues to just be roaring. It's absolutely on fire. Now, what's interesting is that if you look at the market reaction to it, it might be opposite what you'd expect from a really strong number. You might think like, oh, this is going to increase the concern about a Fed getting more aggressive, causing the economy to tip into a deeper recession if they have to really kind of be much more aggressive. But the bond market actually liked it, and consequently the stock market liked it too. And so that's where you have to kind of dig in a little bit more to the detail of the report to sort of see, what are things in here that might be encouraging to a soft landing scenario, to a Fed that isn't quite as aggressive. So let's unpack some of those a little bit. Just looking at the other kind of headline numbers, we see that the manufacturing payrolls number softened a little bit. Average hourly earnings softened a little bit, as did average weekly hours. And the unemployment rate actually ticked up from 3.4 to 3.6%, all on the back of a higher labor force participation rate. So let's try to unpack that in a little bit more detail, understand what's going on more broadly with the labor market conditions, and then what this might mean for the economy going forward. So I'm going to go ahead and share my screen now. Just start walking through some of these indicators. Let me get in the right window here. Yeah. So again, to kind of just put into context, the overall change in the number of jobs. We're running at an average of, around 300,000 jobs now for a year. Now that's a little bit lower than it was back in, 21 and early 22. But remember, that was the big bounce back from the COVID. If we look to, a typical pre-COVID strong labor market, you're talking about something in the 150 to 200,000 new jobs per month on average. So we're well above that, even given how tight the labor market has been. So if we kind of go back to the COVID era, see how jobs have recovered. It took us a long time to get back to where we were pre-COVID, but we continue to just have a soaring growth in overall jobs. So we're well above where we were pre-COVID. No signs of sort of a slowing trend here. So, if we look over the last year or so, suggests that we continue to see very strong job growth, certainly in the headline basis. I mentioned already that there were sort of a little bit of mixed picture inside of the particular industries. So here I've got sort of the 3-month average. That's the first column there. So, the average number of job gains in December, January, and February, again, around 300,000 for overall private employment. And I want to compare that to the job gains that we saw for the previous 3 months before that. So September, October, November. So again, you see the headline, no sign of deceleration there, even, maybe slight acceleration. But when you look inside, well, we're starting to see a little bit of deceleration in manufacturing. So the rate of growth has slowed a little bit for manufacturing, and also for information, so IT jobs. And that, that's consistent with what we know has been happening in terms of layoffs in the tech sector. But you look at construction, certainly there's been concern about what higher rates are going to do to the housing market and broader construction. We're continuing to see construction jobs accelerate, and overall private service producing jobs also accelerate, and even government job growth accelerating. So, despite sort of the kind of flat overall picture for private employment, what's happening under the surface, I would say, is not consistent with a major slowdown. Just things that we kind of narratives we've already known about, especially on the tech sector and manufacturing. So what's the good news then? Why is the market reacting positively to this? Well, it looks like maybe we're seeing a little bit of softening in the wage side, in overall earnings, and especially labor force participation growing in a way that's meaningful. It's been a challenge to get people back into the workforce. We know that a lot of people retired early and didn't come back. There's been a slow reentrant of the prime age workers, the 25 to 54-year-old workers. And so one thing we saw that was really nice in this recent the February report was that we had about 400,000 people enter the labor force. So that uptick that we saw in the unemployment rate from 3.4 to 3.6%, that was all due to new entrants into the labor force. And that's like the best news for the Fed in a soft landing scenario. So what makes a soft landing? If we define a soft landing as, economy kind of coming back into equilibrium without hitting a recession, really the only good way to get there is to have more people enter the labor force. And so you end up with 400,000 people coming to the labor force. That's a big number. And it's nice that we've seen the labor force participation rate tick up for the last 2 months, even with the very strong job growth. So this is sort of the hopefully the Goldilocks scenario that markets are hoping for. The Fed can start to see some benefit from the rates increases it's already undertaken. We start to see labor forces return to pre-COVID participation rates, maybe even start to tick up some to the rates that we saw over the last previous 20 years or so, and this is going to be the solution that gets the Fed out of its current bind. So I think that's what the positive reaction has been. So I'm going to take a somewhat different view of the data, as I'll show you in a minute. If we look at average hourly earnings, it has decelerated a bit. The growth has decelerated a little bit, but it's still really strong, right? If we look at the average hourly earnings growth in February, up 4.6% over the last year. And again, this compares to pre-COVID growth rate of about 2.4% on average. So we're running at like almost twice the rate of average hourly earnings growth, even with this moderation that we've had. If we look at what expectations have been for Fed rates, obviously after the report we had for January, there was big concern that the Fed was going to have to be more aggressive. And in fact, if we look at the increase in rates that are expected, these are expected Fed fund rates. The expectation went from a peak, sometime middle of this year, in the 5% range prior to the January report, all the way up to over 5.5% and a peak until not much later in the year after that report. Now, since then, we've kind of come down a little bit, and I was just looking at the same graph after the data came out, and the expectations are now for a little bit less than what is built into that orange line there. So, but still much stronger Fed aggressiveness than what we saw prior to the January employment report. So, maybe good news just on the margin in terms of what's happening in the labor force participation and wage growth right now. But it still, to me, seems like there is a bias towards much higher rates by the Fed. That they're really going to have to do something more than what they've currently done in order to get the overall labor markets to cool down. So why do I kind of stick with that? And I think this is the kind of view here at the Kenan Institute. We continue to see what we think are the most reliable indicators of future economic activity sort of flashing red. We've seen what the yield curve invert. So our favorite is the 10-year versus 3-month Treasury. It's quite negative now, as negative as it's been since back in the early 80s. So we think this suggests that the bond market is pricing in a relatively hard landing for the economy. I'm going to give it a little bit more color on that. Let's look at inflation and let's think about what the Fed is seeing here. Yes, inflation is off its peak from last year, but it's still much higher, and it seems persistently much higher. And the most recent inflation data that we got last month shows not a deceleration, but an acceleration. So we're going to get more data over the next week or so. That's going to be crucial to the Fed's interpretation. But you look at this graph at what inflation has been over the last year, and it just doesn't look like it's really meaningfully coming down, or it's coming down at a rate that's so slow that it's going to be a long time before the Fed can get back to its 2% inflation target. And then there's a variety of other indicators. I just pulled one out here around household wealth. The household wealth remains really high. Purchasing power for consumers remains really high. If we just look at what kind of cash on hand is by households, and it's across the spectrum. It's not just the top 1%. It's at historically high levels across all wealth levels in U.S. households. So all this to us, I think, means that while there may be some marginal good news in terms of what's happening to wages and labor force growth in the current report, the Fed is still in a place where it's likely going to have to be more aggressive. There was even sort of talk about the economy being so strong that it wasn't a soft landing or hard landing; it was a no landing. So I guess that's in-flight refueling of the economy. In some sense, and that's coming from continued growth in labor force participation, employment, income, And so maybe it's not quite as the same rate, but when you're adding, 300,000 people per month to the economy and they're earning wages now, that's a lot of new income and purchasing power that keeps the economy strong. So in our opinion, the Fed is going to have to continue to be more aggressive. We think the risk is to the upside on Fed tightening. That there is a very good chance the Fed goes beyond 5.5%, and it continues to have to be aggressive to the extent that this will cause a hard landing, a recession at some time. So we're sticking with our recession call, our hard landing call. But again, the timing is the issue. Of course, there will be some recession at some point down the road. When we say a recession, we mean something in the not too distant future, in the next year or so. And I guess another reason we feel confident with this is, think about, how monetary policy works. There's sort of a rule of thumb that's often used, the Taylor rule, that sort of says how accommodative is Fed policy. And that Taylor rule really looks at interest rates, not just on a nominal basis, but on an inflation adjusted basis. So, think about rates right now. The Fed's up in the 4% range, but inflation's up in the 4% range. So the real interest rate remains really close to zero. That's still accommodative by historical standards. So it's really just now that the Fed is getting to an interest rate stance that would be restrictive. And if we think about monetary policy working with a lag of, around a year or so, that means that we're just now moving into that horizon where we would expect a recession at, roughly the 12-month horizon, given how accommodative Fed policy is when you adjust for the rate of inflation. So I think there's just, we're sticking to our forecast that the Fed is going to have to continue to raise rates, that they remain a bit behind the curve, that there's a lot of current strength in the economy that's going to have to come out somehow, and that even an increase in labor force participation and a slight slowing in wages is not going to be enough to kind of significantly get the Fed off the mark in terms of aggressive rate cuts over the rest of this year. So with that, I guess I will open it up to questions, Rob. I hate to be the Debbie Downer on this, but it sort of feels like, good news is bad news sometimes when we're thinking about what the Fed does. And Rob, I'll let you moderate the Q&A then.
The briefing is always done with the shot clock off in March Madness terms. So appreciate your fast-paced analysis on that. We do have some questions in the hopper already, so I'll move straight to those. Peter Pegnataro had brought up the idea about this large group of working age individuals that have been sitting on the sidelines. And you answered that in part because you said that we're starting to see some of that movement, which is exactly what the Fed wants to see. I guess building off of that, is there any way to know whether that will continue? Is this a trend that we can expect to see in the future?
Yeah, I mean, that's the $64,000 question in a sense, right? So, we're still, maybe shy some workers that we would, absent COVID, expected to be in the workforce. Some of those are, the 55 and over crowd that we're unlikely to see come back in. Or, I mean, we'll probably see that participation rate, creep up sort of organically, in the sense that people are aging into that group that are working, and they're, going to be unlikely to retire early like the COVID group did. Women, prime age women are kind of back to pre-COVID levels. Prime age men, not quite there. The question is, what was happening prior to COVID? We were seeing a secular decline in labor force participation after the global financial crisis. So, if we think about just going back to pre-COVID levels, we're pretty much there for prime age workers. If we think about going to, say, labor force participation rate that's the average over the last 20 or 30 years, then we've got more headroom. Then there's considerably more room for people to come back into the labor force. And, jobs are plentiful. It's easy to re-enter the labor force. Maybe we see, a cyclical, uptick just because things are so strong. We saw that pre-COVID. So the few years leading up to 2020 saw, non-trivial increases in labor force participation as we're sort of bucking that secular trend, that longer, 10, 15-year secular trend. So I wish I knew the answer to that question. The Fed wishes it knew the answer to that question, but that is the question in some sense of whether there's going to be the ability to engineer a soft landing.
Okay, good. Thank you. A couple of questions concerning some bank news from yesterday. Both Barbara Senich and Andrew Jacobson ask about that. I'll read Barbara's question. I realize that the venture capital markets are unique and only a part of the economy. That said, they're a supporter of innovation and growth. The current liquidity crisis at the Silicon Valley Bank does get my attention, as would any unusual bank problem. Is this an early indicator of broader potential problems in the financial markets?
Yeah, it's really interesting, and I think it just popped out of nowhere. I think the problems at Silicon Valley Bank, quite a surprise there. Um, let me kind of provide maybe a little bit of backdrop for it. I mean, we know that the VC markets have cooled off. We know that tech in general has cooled off. So I think the question we should be asking ourselves is this more fallout from, a tech bubble bursting that may have very little to do with interest rate policy or broader, economic trends? It's something that's fairly specific to the tech sector, or is this a sign of broader, kind of concern about what's happening to the banking system, another loan, crisis? Are we setting the stage for another, loan default debacle like we saw during the global financial crisis? My read on it is that this is likely to stay isolated in the tech sector, that we're not going to see a spillover. Large banks are very well capitalized right now. There's not a reason to think that there's, at the consumer, in the housing market or at the consumer level, that there's runaway credit problems that could lead to, substantial defaults of homeowners or consumers on their loans. Businesses in general have a lot of cash on hand. Their leverage has creeped up, but I think businesses are continuing to do quite well. So I don't worry about broad corporate defaults at this point, or distress. So my intuition is that this is going to stay isolated in the tech sector. Silicon Valley Bank may be, a subsidiary of Citi or JP Morgan or something like that next week, or Warren Buffett, part of Berkshire Hathaway. We'll see what happens. I think they're in trouble right now. And it's a classic loss of confidence in a particular financial institution, which is very hard to recover from. So, I think we're likely to see something happen at Silicon Valley Bank. But is that going to further disrupt what's happening in tech? Is that going to lead to a massive credit crunch in tech? I don't think so. There's lots of people out there that are willing to lend to creditworthy businesses. So I don't see it as a snowballing, financial contagion inside the tech sector. The question alluded to, the effect on innovation and growth. I mean, I think, there is a concern about, if we overshoot on the tech correction, this having longer term impacts on the economy. But that sort of role of innovation and productivity growth is something that happens, at a much longer frequency, a much longer horizon. So it's not something that I think we need to have a big cyclical concern about when looking at what the economy is going to do in the next year or two. That's more of a 10 or 20-year horizon. Yeah.
Mm-hmm. But in the short term, also stay tuned, it sounds like.
I mean, it's going to be certainly interesting to watch, the train wreck that is, Silicon Valley Bank right now. And, I feel bad, for them, because I think they provide a really unique role in the ecosystem. I mean, they're not just another bank. They're a specialized bank, but because of that, because there is real franchise value to what they do, somebody's going to come in and effectively bail them out or take them over, in my opinion. Yeah.
Okay. Circling back to labor participation for a second, Matt Boyle from Bloomberg asked an interesting question. Said the rate among women is close to a historical high. What needs to be done to get more men to join the labor force?
Yeah, I mean, it's an interesting question. Why has it been harder for men to get back to pre-COVID rates than women? I mean, we've heard, a lot about constraints on women, for example, historically been more likely to have childcare responsibilities or family care responsibilities, and that being a friction there. And yet we see men, not returning more slowly. Rephrase that. We see men returning more slowly than women. So I think part of this could have to do with skills gap type issue. So the types of jobs that are historically attractive to men may not be the types of jobs that they're well qualified for right now. And so, I mean, think about, say, there's a lot of talk around reshoring, onshoring, manufacturing. This is high skill manufacturing. It may be that the men that haven't returned to the labor force are not well suited to the types of jobs that are currently available out there. So, this is certainly an area of concern for the Fed, because they are looking so much to have labor force participation grow. But it is a bit of a mystery to understand why. Yeah.
And we should let folks know that that kind of ties into our grand challenge for 2023, which is called Workforce Disrupted. And I'll direct folks to the website a little bit later here so they can take a look at some of the things that we've already written and put up about those subjects. Let's see. Mark Froman asks, can you comment on global and international influences and trends on your economic outlook? That one's pretty wide open, so take that one where you'd like.
Sure. Yeah. I mean, the news there is definitely positive as well in terms of what's happening to the global economy and what its effect would be for growth in the U.S. in the short run, right? Again, sort of absent what the policy response would be. But if you look at prospects for Europe, you look at prospects for Asia, they're improving. So Europe, I think, avoided the most dire consequences of the energy shock from Russia. Largely because of good luck with warm weather, but also because of a pretty rapid technological response in terms of being able to provide more gas. So Europe, overall is in much better shape than people expected, 6-12 months ago or so, and forecasts for European growth are higher. And then you look at Asia, and a big weight on the Asian economy was the zero COVID policy in China, and now that's being, of course, unwound, and things are going back to normal in terms of production. It was a bumpy unwinding of that because obviously so many people got sick and it affected production. But things are rapidly gearing up again in China, and so expectations for Asian growth are up. Even Japan expectations for Japanese growth are up. So, it's kind of good news around the world. What does that mean for the U.S.? Well, that means a stronger economy for the U.S. because as these economies grow, that means higher demand. Part of that demand is for U.S. goods and services, and so that's going to lead to higher output in the U.S. So, it's another tailwind for the U.S. economy to have the global economy revised up in some sense, expectations for the global economy revised up. Now, longer term, it's not necessarily good news because it means if the Fed has to be in firefighting mode, it means that they're potentially going to have to raise rates that much more or for that much longer, which again increases the chance of a hard landing down the road. So I would say it's unequivocally good in the short run. Not obvious if it's good or bad in the long run, right? It just sort of depends on how other parts of the economy evolve over 6 to 12 months or so.
Okay, we're close to time, but let's try and squeeze one more in. Debt ceiling was all over the headlines. It's not all over the headlines now, but it certainly hasn't gone away. There's a debate that's going to be had. Something's going to happen. How do you foresee this affecting the economy in the next few months?
Yeah, I personally think it's all political posturing, and the risk of real economic fallout from that is almost zero. I don't see that either side, and especially the Republicans, benefit from severely disrupting the economy with a default that would directly adversely affect many of their most important stakeholders. So to me, it feels like a game of chicken between a VW Beetle and a Mack truck, and so the rational economic forces are the Mack truck, and some political posturing of certain Republicans are the VW Beetle. So they're going to swerve or they're going to get run over. That's my personal opinion.
All right. Well, we always like to end it on a good metaphor, so that definitely qualifies. Greg Brown, thank you very much for your analysis and your insight, like we said, as the shot clock was off. So very much appreciated. And good to finally get to do one of these with you.
Yeah, that's great. I hope everybody out there has a great weekend and enjoys some spring weather.
Absolutely. Thank you all for being with us today. Thank you, as always, for your good questions. That's what kind of makes this machine go. So we always appreciate that from you all. To the folks in the media, we'd love to continue the conversation. If you would like to talk to Professor Brown or any of our other experts about the jobs numbers or pretty much anything else, please reach out to me and we can set something up. I'm at rob_knapp at Kenan-Flagler.unc.edu. For everybody who's with us today, we'd love for you to take a look at our website. It gives you an idea of the full range of things that we're doing here at the Kenan Institute. That includes our Grand Challenge, which we talked about earlier, which you'll find displayed prominently on the website. It also includes the American Growth Project, which is our effort to understand better what's going on in the micro economies around the United States, which help come together and create the economic picture as a whole. But there's a lot to be discovered from looking at them individually, and that's what we're trying to do. So stop by the website, kenaninstitute.unc.edu. I think that's everything we have for you this week. Again, we appreciate you being here. We hope you'll be with us again on April 7th, which is the next time we'll have an employment report drop. That might be a holiday for some people, but it won't be for us. We will be here. Thanks again for being here. Appreciate it, and enjoy your Friday.